through the 70s produces more stagflation, and then at some point the inflation problem or the devaluation of money problem becomes such that the central bank then tightens money,
right,
and so on, and
the Volcker years.
The Volcker years.
The Trump administration claimed that
a breakdown look like? What does stage 6 look like?
Well, from the monetary point of view, it is that they're efficient to meet the supply. You are seeing a movement by central banks and countries to hold gold as an alternative reserve currency.
One of them is, like, if the United States government...
Think about what happened after 1971. The United States and the gold standard, the dollar was no longer backed by gold. And suddenly money becomes something that could be expanded for more easily through the 1917 inflation. Such growth slowed, and the country into what economists call stagflation. Price rose, jobs stagnate, and confidence weakened. Eventually, the Federal Reserve was forced to slam on the brakes. Interest rates skyrocketed in the early 1980s under the Fitch-Chappell Walker, triggering a painful decision but crushing inflation. The pendulum swing hard. Now fast forward today, according to billionaire investor Ray Dalio, the United States is moving through a familiar historical cycle, and we are dangerously close to what he calls stage 6, the breakdown phase of a long-term monetary order. He argued America is currently in a stage 5, still the strongest power in the world, but in a relative decline burdened by the debt, internal division, and a monetary strain. Stage 6, he won his when the system itself starts to fracture. Curve. What does the structure look like? From a monetary standpoint, Dalio explained it simply: when the demand for the reserve currency is no longer stronger enough to absorb the supply being created. In a plain English, when too many dollars are printed and too few people want to hold them. That imbalance forced painfully adjustment around the world. Central banks have been increasing their gold reserves. Why? Partly diversification, partly fear. If countries worry about holding too many US dollars, especially in a world where a sensation can freeze, access to those dollars is hope for alternative gold become attractive again. Have assessed region important. When trust weakens, but there's another side to this story: debt. The United States runs enormous deficits and finance them by issuing trustee bonds. Investors, foreign governments, pension funds, and institutions buy those bonds. In a return, the U.S. promised to pay them back with interest. The system works beautifully as long as buyers keep buying, but if demand weakens, interest rate must rise to attract investors. High rate make boring more expensive than slow economic growth. Slower growth reduces tax revenue. Debt burden feels heavier, and that's when central banks step in. If private investors don't buy enough bonds, the Federal Reserve can. That process is now an quantitative erosion. The Fed creates money electronically and uses it to purchase government debt. It injects liquidity into the financial system. This is a policy exploded after 2008 financial crisis, putting the crisis in unemployment in a heat 10% market growth. And the panic spread global. The Fed doubled its balance sheet in a month, providing the trillion in a liquidity among those supporting emergency action. At the time was Kevin Bush, a former Fed governor now nominated by President Donald Trump to potentially chair the Federal Reserve. Bush argued that is an emergency. The central bank must act aggressively to keep market functioning. The balance sheet that once stood near $1 trillion surged to $2 trillion almost overnight. Fast forward to today, and the Fed balance sheet remained vastly larger than before 2008, hovering in the multi-trillion dollar range. Quantitative easing saved market in the short term, but the critical argue is an inflated asset, bubbles and wind and wealth inequality. When the Fed floats the system with a liquidity assets rise stock, real estate, and a financial assets. Solar. Those who already own assets benefit. Those living paycheck to paycheck see little immediate gain. There is a way the conversation becomes uncomfortably. Monetary policy does not impact everyone equal when interest rates are near zero and money is cheap. Corporations borrow cheaply, investors leverage up in a market boom. But when inflation accelerated, the Fed must lighten Higher interest rates increase mortgage costs, credit card payments, business loans, and auto financing. The work class feels its first. Dalio described a trap. If rates rise too much, the government on interest payment exploded because the US has accumulated over $30 trillion in a debt. If rates stay low, inflation persists, and the dollar weakens in a foreign buyer reduced demand for treasury, the Fed may be forced to buy more itself, printing money to sustain the system. The printing risks further deflation. It becomes a cycle that feeds on itself. Historically, when countries reach the stages, investors shift toward hard money. Coal demand rises. Currency volatility increased, political pressure intensifies, and a trust institution erodes now a lawyer in the current economic data. The Trump administration recently claimed that the US added a $130,000 job in January for above expectation that outflow the 50,000. The unemployment rate reportedly fell to 4.3% and wages rose modestly market share. Stock climb optimism return, but job numbers are often revised annually. Benchmarking recently revealed that nearly 9 lakh jobs previously reported were overstated in a peer down revision. November and December number were also adjusted downward. In fact, for one 6 month stretch, the economy may have lost a net total of jobs. Despite earlier positive reports, this a pattern of upward initially estimated followed by the downward revision has fueled in a skeptic's mind. Some economics argue the Bureau of Labor Statistics routinely overestimated early job creation. Others defend the process, noticing that revisions are normally as more complete data becomes available later. In an era of intensity politics for information, trust becomes fragile. President Trump has openly pushed for a lawyer interest rate, arguing that as a stronger economy in the world, the United States should pay the lowest going cost. Lower stimulate growth and reduce government interest expenses, but lowering rates while inflation remain elevated risks.